Hello, investment enthusiasts. If you're seeking a dynamic and profitable approach in the financial market, you're in the right place. Today, let's explore the fascinating universe of growth investments, strategies that have turned giants like Amazon into icons of success. Inspired by notable figures such as Thomas Rowe Price Jr., Philip Fisher, and Peter Lynch, we'll unveil the secrets behind growth investing. And make no mistake, even colossal companies like Amazon still hold exciting surprises for investors. Get ready for a journey of valuable insights. Don't forget to subscribe to the channel to not miss any details. Let's dive in. 5. Overview of growth investment. Investing in growth is a strategy one adopt to boost my capital, focusing on acquiring shares of companies with expansion potential. These stocks are often tied to young or smaller companies, with an expected profit growth exceeding the industry or market average. This attractive approach has the potential to generate impressive returns, though it comes with a significant level of risk, considering these companies are still in their early stages and lack a proven track record. When exploring growth investment, my focus turns to rapidly expanding sectors and markets where new technologies and services are being developed. Profit-seeking occurs primarily through capital appreciation, as many of these companies choose to reinvest their earnings in the business rather than distribute dividends to shareholders. I am aware that these companies may be small or recently publicly listed, holding excellent potential. The underlying idea is that with continuous profit or revenue growth, stock prices will rise in the future. When assessing a company's growth potential, I rely on 5 key factors. Firstly, I analyze the historical and expected future earnings growth over the last 5 to 10 years. For larger companies, I seek a growth of at least 5%, while for those in the $400 million to $4 billion range, I aim for 7%, and for smaller companies below $400 million, I look for 12%. Additionally, I closely monitor earnings announcements, paying attention to market analysts' estimates to identify companies with above-average growth potential in the industry. The analysis also includes checking profit margins because a company may have impressive sales growth, but if profit margins don't keep pace, it could indicate poor cost and revenue management. Return on equity, ROE, is another vital indicator, revealing how efficiently the company generates profits with shareholder investments. We compare the current ROE with the 5-year averages of both the company and the industry, looking for stability or an increase, indicating effective management. Finally, the past and present performance of stocks is crucial. I believe that for a stock to be considered growth-oriented, it must have the realistic potential to double in 5 years. This is a criterion I adhere to rigorously, as it is a practical way to assess whether the company is on the path to significant growth. It's important to note that growth stocks can be found in any exchange and industry but are often in rapidly growing sectors. Compared to value investing, where undervalued stocks are sought, growth investing takes a more future-oriented approach to a company's potential, with less emphasis on current stock prices. This strategy leads me to invest in companies that may be trading at a higher price than their current intrinsic value, expecting that this intrinsic value will grow and eventually surpass current valuations. It's interesting to note that this investment style has its roots in notable figures like Thomas Rowe Price Jr., known as the father of growth investing. Names like Philip Fisher and Peter Lynch have also left their marks, emphasizing the importance of research and analysis in identifying growth opportunities. A contemporary example of a growth stock is Amazon Incorporated, AMZN, which historically has a high price/earnings (PE) ratio but remains one of the world's largest companies with expectations of significant growth in the coming years. This duality between risk and reward is a crucial facet of growth investing, where the promise of substantial gains coexists with the risk of unmet expectations. In summary, growth investment is a dynamic and engaging strategy one adopt to boost my portfolio. I am aware of the associated risks, but the search for innovative companies in rapidly growing sectors motivates me, as I recognize the potential for substantial rewards. This approach requires thorough analysis, considering historical and future factors, and the ability to discern companies with true growth potential in the current market landscape. 4. Characteristics of growth investment. As a growth-oriented investor, I focus my attention on smaller and younger companies that show significant profit potential in the future. This approach primarily seeks capital appreciation, where the goal is to see the value of stocks grow over time. A distinctive feature is that these companies, instead of distributing dividends to shareholders, choose to reinvest their profits in business development and expansion. This continuous reinvestment is a sign of confidence in the company's ability to generate growing profits in the long term. When examining growth stocks, I pay attention to a crucial metric, the price/earnings (PE) ratio. This ratio can be high, indicating that the market has optimistic expectations regarding the company's future earnings. This is a clear indication that I am willing to pay a premium for the stocks, anticipating robust performance in the future. It's important to note that this premium is a bet on the promise of growth, and growth stocks often carry a higher level of risk given the volatile nature of growing companies. Analyzing the dynamics of these companies, I realized that many of them are in innovative and rapidly growing sectors. This strategic choice aligns with the search for opportunities in markets experiencing substantial changes due to new technologies or services. However, it's crucial to remember that while the profit potential is attractive, investing in less established companies implies considerable risk. The lack of a proven track record for these companies adds a layer of uncertainty to the equation, and carefully evaluating the fundamentals is imperative to mitigate this risk. This investment approach, though exciting, requires meticulous analysis and a deep understanding of the financial metrics of the companies in question. Balancing optimism about growth potential and a realistic assessment of risk is a crucial part of growth investing. In my case, being willing to accept a higher price/earnings ratio is a conscious choice, supported by confidence in the innovation and future growth of these companies. 3. Key factors in evaluating growth stocks. When considering the feasibility of investing in growth stocks, I take into account a range of 5 fundamental factors. Firstly, I examine the historical and future growth projections of earnings over the last 5 to 10 years. This indicator provides an overview of the company's past performance, allowing me to assess the consistency of its growth and anticipate its prospects for the future. Another crucial point is paying attention to the company's profit margins. After all, robust sales growth is significant, but if not accompanied by healthy profit margins, it can raise red flags. This metric reveals the company's efficiency in controlling costs and generating profits relative to revenue. If the company surpasses its historical averages for profit margins and those of the industry, it may signal strong growth potential. Return on equity, ROE, also plays a determining role in my analysis. This indicator shows the company's ability to generate profits based on shareholder investment. Comparing the current ROE with the 5-year averages of both the company and the industry offers insight into management's efficiency in optimizing investments and operating the business effectively. Last but not least, historical and current stock performance is of utmost importance. I believe that for a stock to be considered growth-oriented, it must have the realistic potential to double in 5 years. This practical metric serves as a compass to assess whether the company is truly on the path to significant growth. Monitoring the historical performance of stocks is vital, as it provides insights into how the market has reacted to news and events related to the company. When evaluated together, these 5 factors provide a comprehensive view of a company's growth potential. In this analytical journey, it is imperative to consider the interconnection of these elements, understanding how each contributes to the overall picture. This meticulous, data-driven approach guides my decision-making in the search for growth stock investment opportunities. 2. Differentiating growth investing from value investing. My investment approach highlights the distinction between investing in growth and investing in value. While growth investors like me direct their attention to a company's future potential, placing less emphasis on current stock prices, value investors seek opportunities in stocks that are trading below their intrinsic value. In my case, the choice of companies that may be priced above intrinsic value is based on the belief that these companies are undervalued by the market, and this intrinsic value has the potential to grow in the future. The distinction between these approaches becomes even more apparent when looking at the time horizon. While value investors are more inclined to seek undervalued stocks in the present, growth investors like me are more focused on future prospects. This emphasis on the future implies a willingness to accept higher valuations at the moment, provided there is an expectation that the company's intrinsic value will significantly increase. Additionally, the growth investment approach requires a deep understanding of market trends and innovations since many of these companies are in rapidly growing sectors. The analysis goes beyond numbers, involving an assessment of the company's capabilities to adapt and thrive in an ever-evolving environment. This forward-looking mindset is crucial to identifying companies with real growth potential, even if their current prices may seem high. In summary, the differentiation between investing in growth and value is a strategic choice that shapes my investment approach. I choose to look beyond the immediate numbers of stocks, prioritizing future potential and the company's ability to innovate and grow. This approach, while involving a higher level of risk, aligns with my view of investing as a dynamic journey in search of significant opportunities in the market. 1. Notable figures and example of growth investment. My journey into the world of investments is inspired by notable figures who have shaped the approach to investing in growth. Thomas Rowe Price Jr., Philip Fisher, and Peter Lynch are some of these notable influences. These visionaries have contributed to defining the landscape of growth investing, emphasizing the importance of research, analysis, and long-term vision. When looking at concrete examples of this investment paradigm, Amazon Incorporated (AMZN) emerges as an emblematic case. Despite its global stature, Amazon's history reveals a remarkably high price/earnings (PE) ratio. This indicator, often associated with risks, highlights the market's confidence in the company's growth prospects. Estimates of Amazon's earnings per share growth suggest an upward trajectory, despite its colossal size, emphasizing the unique risk-reward dynamics inherent in growth investing. This duality between size and growth potential makes Amazon a fascinating example. The company has not only secured a prominent position in the market, but continues to be seen as a driving force of innovation and expansion. This practical example highlights how growth investment can transcend convention, challenging the notion that large companies cannot offer substantial growth opportunities. For me, this dynamic perspective is an inspiring reminder that growth investment can reveal surprising opportunities, even in companies that have already reached impressive levels of success. And there you have it, explorers of the financial world. I hope our journey through the universe of growth investments was as exciting for you as it was for me. Remember that growth opportunities are everywhere, even in the largest companies, as we've seen with Amazon. Now, to not miss any new episodes full of valuable insights, don't forget to subscribe to the channel. Give that like if you enjoyed today's exploration and share your thoughts in the comments. We're building a community here, and your participation is crucial. Until the next video, investors!